I am at the review sheet in Canvas I put in there for you guys yesterday. Yesterday we went over banks, credit unions, payday lenders, title pawn lenders, so all these financial institutions. Today we're going to get into investing, and I added to the review sheet. I realized I didn't have savings accounts or bonds on there, and I needed to have those on there. So I'm going to get through all this investing today. I'm going to talk about creditworthiness, the 3 C's of credit, and stop there. And I'll get through the rest tomorrow. And then Thursday you take that test, and then that's it. Okay, so there's a number of ways you can invest. Savings accounts, bonds, certificates of deposit, stocks, mutual funds. Okay, and how we look at these particular investments is we analyze them through risk and return. Opening a savings account is one of the least risky things you can do. However, the return on a savings account is going to be really low. More often than not, you're probably not even going to beat inflation, so you actually could still be losing money. Now, it's better than a checking account that doesn't earn any interest, but there are normally better options when it comes to trying to earn interest. Okay, so for example, I have a savings account, but that's for kind of emergency money and things like that. I'm really not trying to get a return on it. The reason being is because the rate is just simply so low. So when it comes to risk and return, when the savings account, it's going to be low risk, but a very low return as well. U.S. Treasury bonds, so when you buy a bond from the United States, which is another way to invest, the interest rate on that is usually going to be a little bit better than a savings account. It may be about 2%, but inflation is usually around 2%. So you're really just kind of protecting the purchasing power of your money. Once again, considered low risk. The United States pays its bills, it pays its bonds, but you get a pretty low return as well, okay? And then again, probably a little bit better than a savings account. A certificate of deposit, it depends on how long you're willing to let your money sit in a certificate of deposit. So if you're willing to let it sit there for 5 years, you may get as high as maybe a 4% return or maybe a 5% return, okay, which obviously beats a savings account or treasury bonds or bills. However, you can't get that money out. So whereas you can pull your money out at any time with a savings account, or you can sell those bonds at any time, with a certificate of deposit, you're going to have to let that money sit there, all right? Considered low risk, but a little bit higher reward than, say, a savings account or bonds. Not considered a risky investment, a certificate of deposit. Really, though, where you have that disadvantage, though, is your money has to stay in the account for a particular amount of time. Okay, if you can go get your money, but you're gonna pay a penalty on it. All right. One of the more higher risk investments is stocks. So stocks, you can get a high return, but you have a high risk as well. So if you invest in a company that's new and has not been around for very long, you've invested all your money in their stocks and they go out of business, you're going to lose the entire value of your stocks. Okay. So, look what's happened to the stock market recently. Let's say you had invested a whole lot of money like Warren Buffett did in the airlines. Okay. So he bought a whole lot of stock in Delta Airlines when it was at like $47. Well, now Delta Airlines stock is selling for about $22. So he lost about half his money on that. Okay. So there you see that stocks can be high risk, but they also carry that high reward potential as well, okay? Mutual funds is a way of what they call diversifying your investments. So it's a way of investing your money in stocks and even bonds at the same time. You do it over a number of different companies, all right? And then why the mutual fund is considered a little safer than the stocks is if one investment goes down, well, the others may still be going up. So you're still in a good place when it comes to that investment, okay? Higher risk, higher reward, but certainly not as risky as putting all your money in one particular stock. Okay, I'm going to skip this unanticipated inflation. I'll talk about that tomorrow. I want to jump down to just creditworthiness really quick, and then we'll stop today. So creditworthiness just means when a bank looks at you, they're looking at your creditworthiness. Should they give you the loan, and then at what terms and what rate? They're going to look at those 3 C's of credit, right? Your character, which is your credit report. So do you pay your bills on time? Do you pay your debt obligations on time? That's going to spit out that credit score for you. All right, that's one of the first things they're going to look at. Then they're going to look at your capacity. Do you have the income to be able to afford the loan? You cannot go get $1 million loan if your income is $10,000 a year. You can't afford it. But you could probably get $1 million loan if your income is $250,000 a year. All right, so that's your capacity. The next thing they're going to look at is collateral. If you cannot pay the loan back, do you have financial assets that they can take from you in order to recoup the losses they're going to take from you not repaying the loan? All right, so your 3 C's, your credit report, your capacity, and your collateral. Okay, all right, that'll be it today.